You have enough common sense to realize that investing is probably the best use of your financial resources. However, it's a lot of work to study the market, track stock prices, and decide whether to sell or buy. Sounds like a lot of work, and it is. But we had the same reaction until we did the effort and uncovered these three ETFs, and now we'd like to share them with you. This is Investing Path. And for today's video, we will be sharing these three stocks that will help you manage and simplify your investment process. But before we begin, please give this video a thumbs up, and while you're at it, click the subscribe and bell button as well to stay updated for more of our content. We won't keep you waiting for too long, so let's get started. Now you can see that we were once in your shoes. Investment capital made the most sense to us because it continues to generate interest and dividends even while we are asleep. We took the plunge since we've always been interested in business and several specific companies in particular. We dove into reading anything we could get our hands on. Over the course of several weeks, we put in an average of 6 hours per day. The best way to learn about a topic is to read as much as possible about it. And so we had to question ourselves, what do I really want? Should I invest because I want to or because I need the money? Well then, we're willing to wager that you agree with us that the latter is the more reasonable conclusion. We yearned for autonomy in our schedule, the ability to travel wherever we pleased, and the security that comes with a comfortable financial situation. Back in the research hub, it became immediately clear that ETFs were the type of investments we wanted to make. Exchange-traded funds, or ETFs, are essentially a diversified portfolio of stocks from different companies. Your grandma could do this with her eyes closed, and she probably is. She's probably generating more money in the long run than half of Wall Street combined. This video will tell you which three ETFs every investor should have, and if you follow the advice, you should have a well-balanced portfolio across all ETF types. We always suggest doing some additional research, so we'll give you two options to choose from. There are only three guidelines to follow for each of these classes. The first rule is that you must never select two options from the same group. The stress of investing might be further compounded if you choose multiple ETFs from the same category, which is often the case. The second rule is to have a clear idea of why you are investing in the first place. The third guideline is that you should always be extremely consistent. Set up automatic payments in the amount you feel is appropriate to invest each month. Let us pretend that the amount of $250 per month, then for the next 40 years, you'll just have to worry about spending $250 every month. Add in the dividends and the passive income, and the total is almost $1.3 million. Quickly reviewing the rule number 2. Know what you want to accomplish. Do you prefer a smaller monthly payment now, or a massive lump sum when you are retired 40 years from now? Which would you rather have right now? Something that starts developing immediately but also pays dividends in 10 years? If you are concerned more about cash flow than growth in the long run, 20 years from now, or if you are nearing retirement age and have a big amount of money to invest, you may want to consider putting most of it in a dividend-style ETF. First, you need to answer the question, how can I get a passive income today? Then we can move on to discussing the three main categories of exchange-traded funds. As a result, we always tell people to begin with the first type of ETF. This, in our opinion, is the groundwork upon which to build any and all investment strategies. And this would be an investment vehicle that tracks the performance of the broader stock market. The first exchange-traded fund that we recommend in this space is VTI from Vanguard, which is a whole stock market fund. There are stocks from more than 4,000 different firms here. The cost to own is only 0.03%, and its average growth over the past decade has been 11.7%. VU, another Vanguard fund that allows the SP 500, is the second exchange-traded fund in this group we find very attractive. This fund invests in more than 500 companies, but only the largest 500 in the United States as measured by market capitalization. Over the past decade, it has increased in value by an average of over 11.5%, and its expense ratio is only 0.3%. However, VU does have a little advantage when considering their top holdings, which are also fairly similar. It's a common question. Out of the two, which do you prefer, VTI or VU? Because they are so similar. As a business professor, we tend to favor businesses that we believe are doing exceptionally well, which is why VU is one of our favorite firms. That's why, Instead of having access to the entire stock market, we'd settle for only 500 largest corporations in the United States. If you're only looking at the stats, you can't go wrong with either of these. Let's move on to the following topic. This one is the most exhilarating and entertaining, but it may also be the most dangerous. We believe we're currently witnessing the latter of those two possibilities, a sharp decline after a sharp rise. The Invesco Triple Q Trust is the first exchange-traded fund in this category that we find promising. You'll find shares from more than 100 different companies. Technologies like artificial intelligence, virtual reality, augmented reality, and even blockchain have enormous promise for development in this area. The fund's expense ratio is 0.2%, which is higher than the average but still reasonable for a growth investment vehicle. This one has grown rapidly over the past decade, with an annual appreciation rate of about 16% over the time frame. In addition, this is rational, given technological advancement has accelerated dramatically over the past decade, and especially during the pandemic. The Vanguard Growth ETF, ticker symbol VUG, is the next growth ETF I like and suggest. It is more diversified than the previous two options, with over 250 stocks in its basket, but still has a heavy emphasis on companies with strong growth prospects. It has a lower expenditure ratio, 0.04%, and has gained less 12.9% over the past decade than Triple Q, but it is 5 times less expensive. You should consider this while investing in a growth fund because both of these have performed exceptionally well over the past decade but are currently under severe pressure. Their results are nearly identical, and in spite of Triple Q's greater actual return, your realized gains will be around the same due to the fund's expenditure ratio. All investors should have some exposure to growth, and the top 10 holdings in these two funds are very identical, so you can choose either one. Now, we'll move on to the third group, high dividend yield exchange traded funds, which is a group in which we've been increasingly investing as our knowledge of the market has grown. These two dividend ETFs only invest in reliable, high-yielding dividend-paying firms. A high yield is often cited as a reason to invest in a firm, but it's important to keep in mind that a yield of 7% or higher can have a serious impact on a business bottom line. Therefore, if the company is offering such a rate, it is likely to be a promotional rate meant to entice you to become an investor. They may be able to keep it up for a while, but dividend investments are meant to be held for the long term, so that you may collect passive income during your retirement. Stop basing your decisions solely on high yield because that makes little sense. When investing in dividends, remember that its stability and a little risk are paramount. This dividend ETF and dividend equities in general are about as safe as it gets, so you can put your money elsewhere if you're looking for bigger returns. The first is VYM, the Vanguard High Dividend Yield Exchange Traded Fund. Close to 400 businesses are represented here. The expense ratio is incredibly low at just 0.6%. The fact that it has appreciated by a factor of 10 on average over the past decade is crucial. Those who invest in this exchange-traded fund will receive a respectable dividend yield of 3.39%, as well as a really good dividend growth rate. This next ETF has a dividend yield of 3.73%, which is higher than VYM's by around 15%. It is a dividend fund with a 10-year appreciation average of 12% each year. Here, we will be referring to SCHD, the Schwab US Dividend ETF. Although VYM appears to have a little advantage, we find it encouraging that SCHD has shown considerably more consistent returns over the past 3, 5, and 10 years. Also, we value reliability when it comes to dividend investing. And that concludes our video for today. Which one of these ETFs are you interested in so far? Let us know in the comment section below, and we'd be more than glad to share our insights as well. But other than that, thank you so much for watching. This is Investing Path. And if you liked this video, please make sure to give us a like, subscribe, and hit the bell button as well to stay updated for more of our personal investment and financing videos. Thanks again for watching, and we'll see you soon.